Okay, Amy, you're with us, right?
I'm here.
Okay, so we're going to bounce back and forth a little bit and take 20, 25 minutes here and just talk a little bit about the general market. We've put together a few slides, and for those that listen to my general market updates, one of the things that I talk about is looking back at history a little bit. You know, the market cycle, super cycle, really from 1974 through 2000 was a major uptrend, and one of the drivers was the baby boomers. You know, an entire generation had entered peak consumption years, and the market from 82 had a huge run. Now, wasn't straight up. There are certainly bear markets along the way in 87, 90, and 98, but the precedent was there. And what I've spoken about a few times is really what I call the current super cycle, which started in 2009. And it's again keyed into demographics. There's 84 million millennials that entered their peak consumption years right around 2019. And it was a couple years later that the oldest millennials were finally turning 40. And so we've had this uptrend, but if we are in a super cycle, it could continue for many years in this peak consumption where millennials are buying houses and cars and financial services. At the same time, we have boomers that are retiring and transferring wealth to the millennials. So it's really a demographic concept of a potential super cycle. Now, to put this in perspective, this is a long-term chart, a monthly chart of the NASDAQ. And I've used this before, and just showing some long-term trend lines. And I've been saying this as this bear market has unfolded, that there's kind of a zone in this 10,000 to 11,000 area on the NASDAQ that the index could fall and still be within these trend lines, long-term trend lines. The 10,000 level of the NASDAQ would be about a 38% decline, and kind of an interesting psychological number. So this zone is really being tested currently. A number of other things that are interesting about this level is there's this confluence of the 10,000 psychological number. The pre-COVID peak was at roughly 98.50, which is shown here. We had the June lows, which have been tested the past few weeks. And actually, this is a 61.8 retracement of the COVID low to the top move. So those that you watch fibs, there's a lot of things going on in this kind of zone between 9,800 and 11,000 on the NASDAQ. If this doesn't hold and we break, there really is not a lot of support. So a break could take us down fairly quickly, but it's just a perspective on the broader side. Now, in terms of the stock market cycle versus the economic cycle, this wheel is really kind of the four major pieces of the economic cycle, from recovery to expansion to peak and recession. We're somewhere in this. We've peaked. The economy will go into a recession. That's, some people say we're there. Some people say we will be there. But we're somewhere in the dial of this area. Now, the interesting correlation is the stock market is always leading. Its stock market is 6 to 9 months in front of the economic cycle. So this chart tries to show that here's the upswings in the stock market, and you can see the lag in the actual economic cycle. So it's important to be aware that the market is looking ahead 6 to 9 months. And this particular chart shows various groups will perform well depending on where we are, if it's an early bull market, a late bull market, and where we are in bear market. So you might want to come back to the slide, but I think it's some perspective of where we are. We're late in the economic cycle, which means, where are we with the stock market looking ahead? So Amy and I pulled up a couple of charts here. This is one that's interesting because these are very defensive groups. This is the consumer staples, the XLP, and the healthcare. Things are pretty bad when, if you look at the action in the XLP, this stuff is price-wise is coming down, yet it's showing relative strength relative to other things in the market. And even the healthcare ETS, the XLV, is showing relative strength, even it's coming down. That's a pretty unusual situation. And Amy, do you want to talk a little bit about the dollar?
Yeah, we've seen this and I've talked about it several times, but look at the dollar and look at how that has completely pressured the S&P 500. You can just see as long as the dollar keeps going up. In fact, a lot of times, John, what I do, we talked about this, I'll look at the futures. And if I see that the dollar is screaming higher again and again, I know what the market's going to do pretty much. It's almost like clockwork. So, the dollar being strong compared to, the other currencies going down, you'd like to say, well, that's good news. But we know that that pressures the multinational companies and it's going to hurt profits and stuff like that. So this is a comparison chart. You can pull this up in MarketSmith and you bring up oil and do this. So I would take a look at this, keep an eye on it, take a look at the futures and what the dollar is doing. It'll tell you really what the market is going to do.
So this is a chart of a number of the different oil-related groups. I've got 4 of them on the chart. The oils topped out in late May and early June, and they had a very severe drop. So they've tried to rebound from essentially pretty deep bases and structures. I guess in the last few weeks, you've seen these groups have started to come back up, and then kind of a little bit going sideways. I mean, do the oils have one last move ahead of them? It remains to be seen, but the oils are, certainly a late stage group. They had deep corrections, and I guess it's just something to keep an eye on. Sometimes deep corrections, it's very difficult for them to make another move, but it's possible.
And one in that group, John, STNG, if you want to know why some of the transports have done better than others, it's the same old story with us with CanSlim. There was a huge jump in their annual earnings. So, it's always looking for, the Rolls Royce in the group. If you're going to play some of these names, you want to make sure you're looking for the best one.
Right. So this is another group.
Yes, John, this is my favorite. When we're talking about Twinkies and Ding Dongs, we kind of know what kind of a market we're in. I mean, we're talking about Goldfish, Kit Kat, Reese's, Twizzlers, Honey Bunches of Oats, Cheez-Its, Pringles, Betty Crocker, Bisquick, Cheerios. I mean, it just goes on and on here. They've done well. I will say one thing. Hershey's in this group, John, has a return on equity of 60%. It has a blue dot in MarketSmith. It has annual earnings that have been up 10 years in a row, and a lot of A+ funds own it. Now, I'm not saying to go out and buy Hershey's, but I'm just saying there's the reason that one of these have been strong. Still look for, the annual and the quarterly earnings.
Right. And as CanSlim or growth stock investors, these are not the types of groups that we're really interested in. And that's why, as Scott mentioned earlier, the best strategy is just to stay to the sidelines for most people, just to stay to the sidelines and watch. Maybe when these groups start to come off and the market starts to move in the other direction, we should see growth stock related groups moving up in the
Exactly.
industry.
I mean, that's if we see these start to go down, John, I think that would be good, and movement back into some growth names. These are defensive names. Play them if you wish, but as I say, when we're talking about Twinkies and Ding Dongs, you just know what kind of a market we're in. Yes, this is the power of 3, taught to me by Fred Richards. Many people have used it, of course, he's not the only one, but take a look at the places where we have highlighted here. What I want to call to your attention is when we get the power of 3, look at the top, thanks Tanya, right there. When they come together, what is the overall trend? So when that power of 3 comes together, look, the trend was heading down. Now take a look where you get the other convergence again in the next place, John. What was the trend doing right there? It was heading lower. Now we get a little divergence there. You got your black arrow, John. Thanks for doing that. Power of 3 here. What was your trend when that happened? Your trend was heading up. And then again, unfortunately, over here, we get another power of 3. And this is the 8, the 10, you can do the 10 and the 21 and the 50. But when you get those moving averages coming together, what is the trend at that point? And that's really going to tell you a lot about where the market is headed.
Yeah, interesting to see those relationships. So a little bit about bear markets, a few statistics, and this is really using S&P. The current S&P low is, we've had about almost a 28% decline. It's taken 280 calendar days. Really definition that I think actually IBD uses and I use is, a 25% decline in the S&P is kind of really what we call a major bear market. And some of the statistics around major bear markets like this with 25% decline minimums, there's been 6 major bear markets since 1971. So this will be the 7th. Now, if you look at those 6 major bear markets, the average loss or decline in the S&P is almost 40%. You'll see we're at 28%, so there could be potential further downside. And you'll also note time. The average calendar days to the eventual low from those 6 major bear markets was 546 days. And we've mentioned this before on meetups that bear markets are measured in months and years. They're not measured in days and weeks. And another interesting statistic is there are usually about 7 failed follow-through days in a bear market as it makes its way to its ultimate low. And actually, I believe we've actually had a 5th that we had a few weeks ago. So these are just some interesting statistics. Now, in general, there are really 2 ways that bear markets can end. And Scott mentioned, I call it type A, which is really capitulation selling. This is really that V that Scott had mentioned, where you have very high volume, you probably get a very wide range and a reversal up. You get basically people throwing in the towel and the market gets, it reverses on us. The other way is really type B, and these are these extended downtrends where they just keep on, there's just persistent selling in the market and the unwinding of former growth stocks, et cetera, and things just keep grinding down until eventually selling completely dries up and the market becomes sold out. So looking at these 6 major markets, bear markets from 71 and to the present, how did they bottom? This is how they bottomed. The 73-74 market, which a lot of people look to, it was about a 50% decline, 631 days, and it really was a type B, extended downtrend. You can look at these yourself, and I encourage you to look at these in terms of types A's and type B's. So we don't know how this, this currently has been a grind down, but we don't know if we're going to get some sort of, capitulation sell-off, which people have been looking for. So I wanted to show you the 70, 73, 74 period because it was a long inflationary period with rising rates. I've labeled, these are all the follow-through days in this bear market. And you can see here's a brief rally. For 5 months, there was a rally of 13%. Here's another 13% rally into the 200-day moving average. And here's a briefer rally as the market continued to get weaker and follow-through day number 8 had failed. And you'll notice that the very last leg of this bear market was just kind of a continuing grinding down. And what's interesting is the final leg down was a constant drip lower. There's almost 3 months where we never saw a follow-through day. That's interesting. And then eventually follow-through day number 9 came and it failed. And then eventually the market became sold out and we got follow-through day number 10 and a new bull market started. So that was amid a recession, but from November of 73 to March of 75. It's noteworthy that the market bottomed before the recession ended. Again, the market is looking forward. So it's just an interesting perspective on one of these longer term bear markets.
And John, can I throw something in there too? It's great
Sure.
stuff, but we love it. You want to go look, folks, take a look at the percent of stocks above the 50-day moving average. And you can go take a look. The best way to do this is take a look at a 20-year chart. You can look at bar charts. Now, right now we're at 18%. The lowest level in the last 20 years in 2009, we were at 13%. So that is one thing you need to follow. The other thing, take a look at the percentage of stocks making new lows. And you're going to eventually, as John has mentioned, you're going to have a capitulation. But then you want to have a contraction. of stocks making new lows. Okay, you're going to sort of test that. And that in every bear market, that's what we've seen is there's a bunch of stocks making new lows, then a contraction of those stocks making new lows.
Excellent point. Yeah, there's some more look at the internals can reveal some divergences which start to get your attention. So now I know we've been talking kind of gloomy, but let's talk about the other side, because out of every bear market are huge, huge opportunities. This is a slide from a greatest winners study that I did. And you'll notice I've marked the bear markets in kind of yellow. And some of the biggest winning stocks of all time came out of these bear markets. You can see here, this bear market went on an 86% move. And here's some of the big winners, CME Group and BlackBerry and Taser and Apple in this particular move. Then coming out of the 2009 bear market, you got Netflix and Regeneron and Priceline, Booking. And then you've got all of these huge winners, and they're coming out of these bear markets. And this was a very tough market in the financial crisis. But look at the move after that. It was a 313% move. And here's the continuation of that chart of that 300% move. And you can see the winners. Then we kind of had what I call a stealth bear market, which was a really tough market in 2015. But coming out of that, we got a follow through day. And you'll notice that was where we got some of the big winners, NVIDIA and Weibo and Viva Systems and Shopify went on major, major runs, and the market doubled again. Then we had the bear market in the last quarter of 2018. We had some big winners coming out of that. And then this chart takes us through the COVID crash and some of the big winners coming out of that, Zoom and Fiverr, and Tesla, et cetera. But the point is, stay engaged with the market, watch the stocks, and when we get the signals that a follow through day is happened, we should be looking for the strongest names.
Yeah, and just to add to that, John, I mean, we're talking about the opportunities coming out of this. We're talking about 1,000% gains. Baidu made 1,000% gain after the 2009. We had Compugen was up 1,000%. Avis Car was up 1,700%. Sleep Number was up 2,400%. In 2003, we had Faro Technologies up 1,100%, 8x8 up 1,900%, Exxon up 1,900%. So yeah, you're going to get some monster winners. So definitely stay engaged. It usually wears everybody out. Everyone just, kind of turns away, and that's probably when it will turn around.
Yeah, great points. I mean, again, when the index makes 100% move, the big winners are they're going up 200, 300, 500%. If you can get positioned in them when the market follows through, and we see a new bull market underway. Now, we tossed in a bunch of stocks that we thought were, watch list ideas. None of these are buy recommendation, but we were just trying to look around for some stocks showing relative strength, and just things you might want to keep an eye on as things develop. I threw up here, Health Equity had kind of attempted to break out of a consolidation. It failed. It's still, relatively close to new highs. It might be trying to recover the pivot. The relative strength has been pretty good the last few months. LPL Financial is another one that it broke out, but it really couldn't go anywhere. But even if as it went sideways, you'll notice that the relative strength line was extremely strong. And as the stock is pushed higher now, the RS is at all-time highs. So that's something to keep an eye on. And Elf Beauty is another one which broke out of this cup with handle and has been it's been working. It came back and tested its 50-day moving average as the indexes have tested lows. But again, a pretty strong RS line. Anything you want to say about these names, Amy?
Yeah, you know what I'll do, John? You and I went over a lot of these last night. I'll type in a bunch of the other healthcare names to keep an eye on. I would like to say out of the healthcare group, that's CCRN, that's Cross Country Healthcare. The reason why has it performed the best? So you always have to go back to the why. As Scott said, do your homework. The earnings and sales, look at those triple digit players. CCRN really had the great strength. And you've brought up some great names here. I'll put some more in the chat. One more thing, John, when people are looking for these names, like how would you have found HLIT? That's harmonic. Go through your MarketSmith relative strength at new high, up on volume, and you can look in the EIBD, the digital subscribers here, you can look at stocks making new highs. I just happened to be glancing through and I said, oh yeah, okay, that's making a new high. I went over and then looked at the chart. So, just keep doing your homework. There's, you have to do it just every day and every weekend.
Exactly. A few other names. These charts were clipped over a week ago, so some of them have weakened their charts since then. But I think, again, these were some names that either have interesting stories or they have some interesting fundamentals to maybe warrant just being on a watch list. This is Shift4 Payments. You'll see that the stock, has a prior uptrend and it's been moving sideways in a consolidation, which is, really, really strong given the weakness in the market. Interesting is fundamentals look very strong going ahead into next year, and you can see the earnings and sales are there, even in a tough environment. It's a good watch list candidate. Wolfspeed has an interesting story. We're going to hear more about this stock later today, so I won't go into great detail, but they have something new happening at the company. It's a semiconductor stock, and we'll wait to hear a little bit more on that this afternoon. Neocrene Biosciences, this is a biotech, but the interesting thing about it is this is a biotech that has real earnings and sales versus a more speculative biotech that is awaiting drug approval. So you can see they've got significant sales. They actually have 1 or 2 products and a few others in the pipeline. And what's interesting is they do have a pretty good growth number for 2023, and the stock has been going sideways in a consolidation. And you can see the RS, this stock is holding up much better than the market. And you'll also notice the signs of accumulation. Big blue spikes here. And in the base, you're seeing some more blue spikes. So there's definitely some accumulation and something interesting going on with this company for a watch list. And I think the last one we have is Shockwave, and I'm going to speak about this one later in the day, but I'll leave it short to say very strong fundamentals, earnings and sales, and they have a new product, and I'll share more about what their new product is, and they also have some pretty good estimates going into 2023.
Yeah, and I know you're going to talk about this later, John, so I don't want to steal your thunder here, but if you just take a look at the gap up that was there, can you scroll over that? Yeah, right there. To me, this stock was viable right here. If you were not, if you waited until that earnings report came out, that was just an excellent place to buy it. Was not really in the typical base breakout right there, but to me, that's definitely viable. And we're getting into earnings season, and I know we have not had a follow-through day yet, but you may get some chances to make some plays. So this is, again, just a reason to pay attention. We really get into earnings. I mean, next week we have Tesla and Netflix. The week after that, we've got, big giant names. One more thing I would say, follow Apple, so goes Apple, so goes the market. And also, believe it or not, look at McDonald's. Take a look at it, throw it up on a monthly chart onto MarketSmith, and you will be surprised. Just go back many, many years, do the date change that Arusha was doing in MarketSmith, and take a look at these. And, you just sort of read the barometer of what's going on in the overall market, in addition to, of course, reading the big picture and all that kind of stuff. But those are just some ways to gauge what's going on in the market.
Okay.
Hey, John, we have a couple of questions on the stocks. Can we ask them now versus diving into?
Sure, we could take a couple questions. I think we all have one more slide, but we have some time.
Yeah, just real quick. So HQY and LPLA, can you provide a little bit more content as to why you think these are interesting versus some of the usual canceling criteria, the EPS number and the sales number?
Yeah. So I think we threw these up really because of relative strength. In terms of they've been holding up better than some stocks in the market. LPL is a financial stock benefiting from higher rates, very, very strong. Elf Beauty is kind of a question mark. It's been acting well. When I looked at the numbers weren't impressive. So I'm not sure why it's, maybe there's something coming down the road for this stock, but you can't deny the price action.
John, since I know you don't fool around with makeup, I'll tell you that it's popular with the younger crowd. It's cheap. To be honest, it's cheap makeup. This is not what you're going to get at Neiman Marcus. And so the price point on this is what is attractive. And I think that that's what's going on there.
Yeah, so these
Thank
are
you.
put up just as really relative strength, things holding up in the market, where the other names I think are more in the growth sphere, and they have much better numbers, I'll say.
Thank you.
Sure. Okay, so the last slide we have, and we could take maybe a couple questions, is, what are we looking for at market bottoms? This is kind of a list that I use, and Amy's going to chime in with a few things that she looks for. But essentially, we want rally attempts that show breadth. We want to see an improving AD line, advanced decline line, and we want to see some leading growth stocks starting to show good action, good price action. So the breadth is really important to watch on rally attempts. Also, Amy mentioned this or alluded to it. I always look for a positive divergence. When the index makes a new low, we want to see fewer NYSE new lows, which are showing that the broader market is not as weak as the index. Obviously, as Scott hit home today, we want to see a strong follow-through day. I think the minimum criteria at IBD is 1.25. That's a minimum. I really want to see a follow-through day at 2, 3, 4, 5%. And I want to see really big volume. And follow-through day with good characteristics on day 4 is more meaningful than a follow-through day that comes on day 12 or 15 or 20. But in conjunction with that, you need to see strong growth stocks that are setting up and breaking out. So it's key. Sentiment, now don't forget, sentiment is a secondary tool or even a tertiary tool. You never trade on sentiment, but want to see sentiment kind of at extremes. Now, we have seen the AAI survey at the lowest number of bulls in 6 years. So there's a number of sentiment indicators that have been at extremes, but this is why we don't trade off of it, because we still want to watch the price and volume action to give us more primary clues. The news will be horrible when the market eventually bottoms. And we certainly have been getting a large dose of, bad news, rising rates, inflation, and you can go on and on and on. So usually the news is really, really bleak when we finally get the bottom. A key thing that I look for is growth names will stop going down or they'll even go up on bad news. And that usually is an indication that even though there's bad news, the stock actually, there's no more selling. Essentially the sign that maybe that stock has been sold out and it's really dry on the sellers. So it's a contrary kind of thing to look for. But most importantly, you want to see quality bases. You want to see new merchandise, and this can't be overemphasized. Stay away from the former leaders. Those names are not likely to come back. So stay away from the Shopifys and the C Limiteds and the Rokus. They very, very rarely will come back. You want to do your screening. You want to find new names. And we showed you a couple of them earlier on those slides. So bull markets usually get led by new merchandise, and you want to see relative strength. Amy, you want to add some more?
Yeah, I hate to harp on this, but we really need the dollar and oil to retreat. Those are key things. We got to get that inflation down. We have to have the 10-month curl. I will go all the way back to a monthly chart. And I hate it when I'm right about this, but I mentioned this, I think, when we did the joint meetup thing, the webinar, when you get that 10-month really curling down, which it has, it takes a while for us to turn the bus around. It just takes it lags a little bit. On the other hand, go back and look at the 2003 bottom, take a look at 2009. When you get that 10-month curl moving up, that really can give you a lot of conviction. That plus, the follow-through day. We need the financials to be strong. You need the financial markets participating in this. And as John said, what are the number of stocks on the IBD lists? Are they working? Are we getting breakouts? I think, John, you and I chatted a little bit. I had a dinner party in 2009, and everybody was like so worn out. And it was March. We had the follow-through day, and people were like, I don't believe this one. I just don't think it's going to work. And I just held up at that time, it was the IBD 100. And I said, take a look at the stocks breaking out. I mean, this is happening. We are in the middle of, we're in the beginning of a new bull. So it'll be exciting when you start to see things working. In fact, I think the joke around, you know, when with Scott O'Neill, Bill O'Neill, and all of us talk, when there's so much merchandise, like which one do I buy? Which one's going to be really the big winner? When there's so many things, you know, that's what you look for. But, you know, go study the past winners. I'm sure most of you have, you know, take a look at Baidu, take a look at how many weeks up in a row that went. Those are the kind of names that we want to look for. We need a lot more stocks above their 50-day moving average. The stronger that can get, the better. Let's see what else we have here. We're going to get the golden cross, the 50 above the 200, but that's going to be lagging because we're going to get a follow through day before that. What else do we have, John? I think that was pretty much for my notes.
Yeah, that's it. I think that's our segment on the general market. It's almost 12:30. I don't know, maybe we could take one question, Victor, or two, maybe quick ones before we take a short break.
I think you guys answered some of the questions. I think the audience enjoyed just listening about your interpretation of what the market is doing. I just want you guys, for the benefit of everybody else, to talk about your personal views and maybe experiences about bottom fishing. I think Mark Minervini, who's with us today, he spoke very forcefully about that on the Twitter the other day, and saying that they're all going to blow up right now. I just, you know, I continue seeing questions. Why can't we buy now? What are we waiting for?
Oh, sorry.
Yeah, I mean, this is important. There's no reason to buy the bottom. If we're going to transition into an uptrend in a bull market and there's merchandise to buy, you don't need to be the first person to buy. You need a follow through day. You need to see quality setups. If you keep trying to make probes when you don't see anything on this list, you're going to get cut up and you're going to take losses, or you're going to get stuck holding something that gaps down. So, you know, a bull market, a real bull market, is, if it's going to kick in, is going to go on for, you know, 6, 12, 18 months. So, you know, everybody seems to be obsessed about finding the earliest point to get in, and you don't need to do that and take excessive risk. It's just not necessary when you can, you know, wait at the proper time and get in on the good leading stocks, and you'll do really well.
And, you know, we could get, John, you know, we could really get another bear market rally. And, you know, we play those. We absolutely play those. I mean, you know, Mkts, you know, that was a great winner. So you're going to look for the earnings. You're going to see if we get some sort of a turnaround. We get a counter trend rally. And maybe, you know, then we'll last for a little while there. But the way I can catch a lot of, you know, what is working in the current market, take a look at the leading industry groups, and you can find that in MarketSmith. You can find it in the EIBD. You know, whatever industry groups are leading, that'll tell you a lot about what the market is doing.
Right. I mean, you know, we had a nice bear market, turned out to be a bear market rally, you know, from July and August, and it was playable because we were seeing some good volume, and there were some names starting to move. But it got, you know, it got halted basically at the 200-day moving average, and it got really shut down with the Jackson Hole speeches by the Fed emphasizing its hawkishness. So, you know, they're playable, but you know, when it got to be flexible. If you see that things are going to go the other way, you got to be flexible. And this turned out, we didn't know if that was going to be the launch of a bull market or just a bear market rally. You know, now we know. But if you interpret what's going on every day, you'll get pushed out of the market. So just read it day by day. And as Scott mentioned, don't try to predict, just try to interpret what we're seeing.
Yeah, and are the breakouts working? You know, sometimes somebody will send me an email and say, gee, nothing that I'm buying is working. And I think I'm buying, you know, good quality merchandise that has good numbers. And so that tells you something about the overall market. If what you're buying, you know, it's sort of the 3-stage process. How is the overall market doing? How are stocks on the IBD list doing? And how is your portfolio doing? And if you're out of sync with one of those, if your portfolio is not matching what the overall market is doing, step back, maybe don't trade for a week or so, take a look at it. Are you getting into the right stocks? Keep reading the big picture column, so you're staying in step with what's going on. But it's the three-part, John. It's really the overall market, our IBD stock, the stock list. Are they working? And is your portfolio working?
Excellent. Okay, Victor, so we're going to wrap up here, and we're going to take a 10-minute break, everyone. And then actually, I will be next up with my presentation called Winners and Losers. So